Well, good morning. It's Greg Bell from the Ray White Surfers Paradise Group, here for another fantastic interview. Rather than the real estate industry, I thought I'd bring along our loan specialist here at Ray White, Rodney Weir from the Green Finance Group, which is part of the Ray White network of loan market offices. So I wanted to get a real feel with falling interest rates, the sort of pressure around superannuation funds, and what impact this is all having on the property market, particularly the commercial market throughout Australia, but in my case, Southeast Queensland. So welcome, Rod.
Thank you, Greg.
And tell me, we've just had another interest rate reduction last week, and we're sort of at rock bottom. What's the impact on the market going to be with that?
Look, it can only be a positive thing. The lower money gets, the cheaper it gets for people, and the more people can actually get out there and spend. But more importantly than the falling interest rates is the banks are actually governed in how much they can lend, not so much by the interest rate, but by a serviceability rate, which is when they work out how much you can afford to repay on a loan based on your income and your financials. They don't look at what it's actually going to cost you. They build in a higher rate to build in the fact for interest rate increases over the next 5, 7, 10 years, however long you're going to keep that asset. As of last Friday, APRA have abolished the serviceability rate that they were utilising. Now, they have abolished it from where it currently was sitting, but they have said it's up to the banks to put their own limit in place. The general consensus is that the serviceability rate will come down by a minimum of 1%, which basically means the average Joe Blow on the street could expect to be able to borrow maybe $80,000, $100,000 more, depending on his income, than what he could have borrowed last week. So the freeing up of money is what is going to help push things along.
That's good. And do you see interest rates falling further throughout the course of this year?
Look, it's an unknown question, and it's
$1 million question.
It is, and it's also a double-edged sword. As much as the falling interest rates is done as a way to stimulate the economy, because the very basic understanding of it is, if you're paying less on your home loan or on your mortgage or whatever loan you've got, then you've got more money to go and spend in the community. Whether you go out to dinner or take the kids to a theme park or something, you're spending money which is meant to stimulate the economy. When the interest rates have fallen, not everyone is actually doing that. People are taking the opportunity to pay more of their loan and bring their debt down, get down household debt, rather than going and spending that money in the community. So at the moment, the two decreases we've had in interest rates have not flown through to doing anything to assist growing the economy. So the general thought is there needs to be at least another drop. Whether that drop comes in the later half of this year or in the start of next year, the consensus is that there will be at least one more drop.
Right. And tell me about interest rate reductions, one thing, if you're a borrower. But if you're a depositor on a long term, where's your returns going to sit?
Yeah,
so
nowhere.
I've got several $100,000 or $1 million even in my super fund, and it's with a bank, and I've just had some interest rate reduction. What do they expect to get as a percentage return on today's market?
Yeah, they'd be pushed to get 2% at the absolute best. And particularly with money in self-managed super funds, a lot of people, what we're seeing over the past month or so, are actually pulling their money out of self-managed super funds and buying commercial property. They're putting the money into property which has got long-term leases and strong national tenants, and they're actually even prepared to pay above market odds. And there was one property up in Brisbane last week, a childcare centre. It was listed with offers over 3.6. It sold for $4 million. So more than 10% above the price, and it was bought with cash out of a super fund. The buyer actually said, at a return of 4.8, said, I'm getting triple what I was getting with my money sitting in the bank.
Right, okay. I've noticed it too, that the commercial market, as long as you've got good quality tenants, the demand is very strong. And I suspect it's exactly what you said. People are looking for returns. Now, if they're only getting 1.5%, or as you said, 2%, they potentially, with a good tenant in commercial, they might get 5-6%.
Yep.
So they're grasping at that, and there's not an enormous amount of commercial properties coming on the market because those vendors are saying, okay, well, if I sell, what am I going to buy?
That's right.
Or where am I going to invest my money? So it's a double-edged sword at the moment.
Very much.
But it is a very strong competitive commercial market, and we're seeing great growth. And the challenge is, you know, vendors, I will see prices or yields come down and prices rise.
Yes.
So we're in a good market with limited stock at the moment. So if you were a superannuation investor, what are the rules and regulations around what you can do and what you can't do? Are you allowed to borrow from a bank?
Yes.
In your super?
Yes, a super fund can borrow from a bank, but it is limited recourse borrowing. Now, basically what that means is you can only ever borrow once. If you go and buy, say, that commercial building down the street, if you then go and put all your money in it and you've paid that off over the next 5 years, you cannot mortgage that property again. It can't be remortgaged or leveraged against for you to go and buy another property. It is a single asset and a single loan only. So what I generally recommend to people is that you don't go and throw everything into the loan. Keep your super funds building up because you don't know what tomorrow is going to bring. You don't know in 2 years' time if you want to buy another property. And if you've thrown everything into paying that asset out, then you've got no cash to buy your next property. So your returns plus your normal super, have them going into your self-managed super fund, have the repayments for the loan coming out of the fund, but your fund balance is then increasing. Then in 2 years' time, you can have a look and say, well, I've got 200 grand sitting in my fund. I don't need that, I'm not going to do anything. Swing 100 grand over to reduce the loan.